You spent 40 years working. 40 years of every paycheck having money taken out for Social Security. You did not choose that. You did not have a say. It was the deal. And the deal was simple: you pay in now, and when you retire, you get it back. So imagine sitting down at the kitchen table in retirement. Your first Social Security check has arrived, and then you open a letter from the IRS telling you that a portion of that check, the money you already paid taxes on, is taxable income again. And then imagine on top of the federal government, your state also sends a bill, because in up to 8 states across America, your Social Security check gets taxed twice. Nobody put this in the brochure. In today's video, we are going to break down everything. Exactly how Social Security gets taxed at the federal level, which states still take a cut, which 42 states do not, the legal strategies that can reduce or completely eliminate your Social Security tax bill, and a brand new government rule that most people over 65 have no idea about that could change your math dramatically right now. And stay until Section 5, because there is a 4-year window closing in 2028 that could legally wipe your Social Security tax bill to zero. We will tell you exactly how. Let us start from the beginning, because most people do not fully understand how the federal government taxes Social Security, and the details matter enormously because they directly determine how much of your check you actually keep. Here is the core rule. The federal government uses something called your combined income, also known as your provisional income, to determine whether your Social Security benefits are taxable, and if they are, how much of them get added to your taxable income. Your combined income equals your adjusted gross income. That is everything else you earn, plus any tax-exempt interest you receive, like from municipal bonds, plus 50% of your annual Social Security benefit. That is the formula. Write that down if you have a pen nearby. Now, once you have that combined income number, here is what the IRS does with it. For single filers, if your combined income is below $25,000, 0% of your Social Security is taxable. Between $25,000 and $34,000, up to 50% becomes taxable. Above $34,000, up to 85% of your Social Security benefits are added to your taxable income. For married couples filing jointly, zero tax below $32,000 combined income, up to 50% taxable between $32,000 and $44,000, and up to 85% above $44,000. Now, an important clarification before we go further, because this confuses almost everyone. These percentages, 50% and 85%, are not tax rates. They are the percentage of your Social Security benefit that gets added to your regular taxable income. You then pay your normal income tax rate on that amount. Here is a real example. Suppose you are a married couple receiving $36,000 per year in Social Security benefits, about $3,000 per month. You also withdraw $30,000 from a traditional 401k. Your combined income would be $30,000 adjusted gross income, plus half of $36,000, which is $18,000 for a total combined income of $48,000. $48,000 combined income is above $44,000, so up to 85% of your $36,000 Social Security benefit, which is $3,600, gets added to your taxable income. If you are in the 12% federal tax bracket, that means you pay roughly $3,672 in federal income tax on your Social Security alone. Over 20 years of retirement, that is over $73,000 going back to the federal government. Now here is the detail that genuinely makes financial advisors angry. The income thresholds that trigger Social Security taxation, $25,000 for singles, $32,000 for couples, have not been adjusted for inflation since 1983 and 1993. Not once in more than 40 years. Financial experts call this bracket creep. The IRS doesn't need to raise taxes. They just leave the lines where they are, while your income naturally grows, and more of your benefits become taxable every decade. According to estimates, about 40% of Social Security recipients pay federal taxes on their benefits. By the time today's younger retirees age through their 70s and 80s, that number could be significantly higher. Here is the good news that far too many people do not know. 42 states plus the District of Columbia do not tax your Social Security benefits at all. That is the majority of the country, by a wide margin. This includes 9 states with no income tax whatsoever: Alaska, Florida, Nevada, New Hampshire, South Dakota, Tennessee, Texas, Washington, and Wyoming. In these states, your Social Security is untouched, and 33 additional states have income taxes, but they specifically exempt Social Security from being taxed. States like California, New York, Pennsylvania, Illinois, Georgia, Virginia, and more. But here is where it gets complicated. 8 states, as of right now, still impose state income tax on Social Security benefits for at least some retirees. Those 8 states are Colorado, Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Utah, and Vermont. And before anyone living in those states panics, most of those states offer income-based exemptions that protect lower and middle income retirees from the full tax. Let me walk through each one briefly. Colorado, if you are 65 or older, you can deduct your entire federally taxable Social Security benefit from state income. Residents age 55 to 64 get the full deduction if their adjusted gross income is $75,000 or less for individuals and $95,000 or less for couples. Colorado's overall Social Security tax burden is low for most retirees. Connecticut, single filers with adjusted gross income below $75,000 and married couples below $100,000 pay zero state tax on Social Security. Even above those thresholds, 75% of benefits remain exempt. Connecticut protects most of its retirees from this tax. Minnesota. This is the one that catches people. Minnesota has some of the highest income tax rates in the country, up to 9.85% for top earners. Social Security is fully exempt for single filers below, roughly 84 out of 490, and married couples below 108,320. Above those thresholds, benefits phase into taxation. High-income retirees in Minnesota face the steepest state Social Security taxes of any state in the country. If you are a high-income retiree living in Minnesota, your effective combined tax burden on Social Security benefits, federal plus state, could be among the highest in the nation. That is not an exaggeration. Montana follows federal rules closely. Low-income retirees below $25,000 single or $32,000 married pay. No state tax on Social Security. Above those thresholds, the federal formula applies taxed at Montana's state rate of 4.7 to 5.9%. New Mexico generous exemption. Residents with adjusted gross income below $100,000 for individuals and $150,000 for couples pay zero state tax on Social Security. Only higher earners in New Mexico face any state Social Security tax at all. Rhode Island benefits are fully exempt. If you have reached full retirement age and your income is below $107,000 for single filers and $133,750 for married couples. That covers a large majority of Rhode Island retirees. Utah taxed at a flat 4.65% state income tax rate. However, Utah offers a retirement income tax credit that offsets the tax for lower income households. Single filers below $54,000 and joint filers below $90,000 may qualify for the full credit. Vermont benefits are fully exempt for single filers, below $50,000 and married couples below $65,000. Above those thresholds, Social Security phases into full taxation for single filers, above $60,000 and married filers above $75,000. Now here is the part of this conversation that most financial media is not covering closely enough. The map is changing, and it is changing fast. Kansas eliminated its state Social Security tax in 2024. Missouri eliminated it in 2024. Nebraska completed its phase-out in 2025. West Virginia began a phased elimination. And as of the 2026 tax year, Social Security is completely exempt in West Virginia. 4 states dropped their Social Security tax in a 2-year window. The momentum is real. States are competing for retirees, and retirees bring spending, housing purchases, and economic activity. The states that tax Social Security are increasingly the outliers. Minnesota, Rhode Island, and even Utah have seen active legislative proposals to reduce or eliminate state Social Security taxes in recent sessions. Whether those bills pass, stay tuned, but the direction of travel is unmistakable. There is a phenomenon that retirement planners call the tax torpedo, and it catches thousands of retirees every year, completely off guard, including people who spent their entire careers diligently saving and investing. Here is exactly what it is and why it happens. Remember that combined income formula we covered earlier? Your adjusted gross income plus tax-exempt interest, plus 50% of Social Security. Every dollar you add to that adjusted gross income number does not just get taxed once. It can cause more of your Social Security to become taxable at the same time. Here is the thing that will make you sit up straight. When your income rises in the mid-range Social Security taxation zone, adding $1 of income to your adjusted gross income can increase your total taxable income by more than $1. Because it also causes more of your Social Security to become taxable. It is effectively a hidden surtax on middle-income retirees, the most common trigger of the tax. Torpedo is required minimum distributions, commonly called RMDs. If you have a traditional 401k or traditional IRA, the IRS requires you to start taking withdrawals at age 73. You do not get a choice. The amount is calculated based on your account, balance, and life expectancy tables. Here is why this ambushes people. Someone retires at 65 with a modest income. Their Social Security might not be taxable at all. They live comfortably. Then at 73, their RMDs kick in. Suddenly they have $40,000 or $50,000 or more in additional income. They are required to take whether they need it or not. That income shoots their combined income well above the threshold. Their Social Security, which was previously tax-free, becomes taxable. And the RMDs themselves are taxed on top of that. Other income sources that commonly push retirees over the threshold include part-time or consulting income. Even modest amounts matter because the thresholds are so low. Investment dividends and capital gains from taxable brokerage accounts, interest income from CDs and savings accounts, pension income, and even tax-exempt municipal bond interest, which most people believe is completely tax-free, actually counts toward your combined income for Social Security purposes, even though you pay no income tax on it directly. Here is what a financial planner told a client that summarizes this perfectly. The problem isn't that you make too much. The problem is that the government never updated the rules to match what normal people make today. A couple receiving $40,000 in Social Security and $30,000 from a 401k is not wealthy. But under 1983 rules, they look wealthy to the IRS. Let's get into solutions. Because unlike many tax situations, Social Security taxation is not something you are completely stuck with. With careful planning, ideally, starting years before you claim benefits, you can legally reduce and, in some cases, completely eliminate the federal tax on your Social Security income. Here are 8 proven strategies. This is the single most powerful long-term strategy for reducing Social Security taxes, and it must start before you begin collecting benefits. Here is the concept. A Roth IRA conversion moves money from your traditional pre-tax accounts, your traditional IRA or 401k, into a Roth IRA. You pay income tax on the converted amount now, but everything in the Roth grows tax-free. And critically, for Social Security purposes, withdrawals from a Roth IRA do not count toward your combined income calculation. They are invisible to the Social Security tax formula. If you retire at 62 and wait until 70 to claim Social Security, you have up to 8 years to convert traditional IRA money to Roth at favorable tax rates. During those years, your income may be lower than it has been in decades. You fill up low tax brackets with conversions. And when Social Security starts at 70, your Roth withdrawals in retirement keep your combined income below the taxable threshold. Strategy that costs you some taxes now saves you vastly more later. The reason this is especially powerful right now in 2025 through 2028 will be covered in strategy number 3. But file this in your mind. Roth conversions before claiming Social Security is the gold standard approach, recommended by virtually every retirement tax expert. Delaying Social Security to age 70 does 2 things for your tax situation, not just one. Most people know the first benefit. Your monthly check grows by 6 to 8% for every year. You delay past your full retirement age. Waiting from 62 to 70 can increase your benefit by as much as 76%. But here is the tax benefit that nobody talks about. When you delay Social Security, you can use those pre-claim years to do Roth conversions, draw down traditional IRA accounts strategically, and manage your combined income before Social Security begins, stacking on top of everything else. It is a planning window, and the bigger your benefit at 70, even though it is nominally more income, can actually result in fewer taxable years because your combined income calculation changes in ways that favor you with careful planning. Strategy 3. The 2025-2028 Senior Deduction, a Limited Window. Most people are missing. This is the strategy most people have no idea about. In July of 2025, the federal government signed a new law called the One Big Beautiful Bill Act. Tucked inside it was a $6,000 per person deduction available only to taxpayers aged 65 and older. For a married couple where both spouses are 65 or older, that is $12,000 in additional deductions, on top of the standard deduction for tax years 2025 through 2028. And then it goes away. Why does this matter for Social Security taxes? Specifically, because this deduction reduces your adjusted gross income. And a lower adjusted gross income means lower combined income. And lower combined income means less of your Social Security is taxable, or possibly none of it. This deduction phases out for single filers above $75,000 in income, and married filers above $150,000. If you are below those levels, and you are 65 or older, this is available to you right now, for every tax year from 2025 through 2028. The window is 4 years. If you are eligible, you need to be capturing this every single year. Talk to a tax professional or CPA about how this interacts with your specific situation. This is not a minor tweak for many middle-income retirees. This could be the difference between paying federal Social Security, taxes, and paying nothing. Strategy 4. Qualified charitable distributions from your IRA. If you are 70 and a half years old or older, and you have money in a traditional IRA, this strategy is extraordinary. You can donate directly from your IRA to a qualified charity, up to $105,000 per year in 2025. And that withdrawal counts toward your required minimum distribution, but it never hits your adjusted gross income. That means it does not go into the combined income formula, which means it does not make your Social Security more taxable. If you were already planning to give to charity, a church, a university, a nonprofit, giving through a QCD is almost always the most tax-efficient way to do it in retirement. A $20,000 QCD from a traditional IRA can reduce your combined income by $20,000, potentially pulling your Social Security benefits back below the taxable threshold entirely. Charitable giving that simultaneously reduces your tax bill. That is what financial planning is supposed to look like. Strategy 5. Manage your withdrawal timing and sequencing. The order in which you pull from your retirement accounts matters enormously for Social Security tax purposes. Here is a simple framework. In the years before Social Security starts, draw from traditional IRA accounts to fill low tax brackets or do Roth conversions. Once Social Security starts, draw from Roth accounts first. To keep your combined income low, use traditional IRA withdrawals last, only when needed. Additionally, spread large IRA withdrawals over multiple years. Instead of taking a large lump sum in 1 year, a single large withdrawal can push your combined income dramatically over the threshold in that year. Spreading the same total withdrawal over 3 or 4 years keeps you in lower brackets each year. Strategy 6. Use HSA funds for medical expenses. If you have a health savings account from your working years and you have not spent it down, this is a retirement tax gem. HSA withdrawals for qualified medical expenses are completely tax-free. And just like Roth withdrawals, they do not count toward your combined income calculation for Social Security taxes. In retirement, when medical costs typically rise, using your HSA strategically keeps your taxable income lower, which in turn keeps more of your Social Security tax-free. Strategy 7. Avoid large one-year withdrawals. One of the most avoidable tax mistakes in retirement is taking a large one-year withdrawal from a traditional IRA or 401k for a major purchase, a home renovation, a car, a family trip without thinking about the Social Security tax consequences. That single withdrawal can spike your combined income well above the taxable threshold. For that entire year, triggering taxes on Social Security benefits you would have otherwise received tax-free. Plan large purchases to either use Roth funds, taxable brokerage accounts, or to spread IRA withdrawals across years. Strategy 8. Work with a CPA or fee-only financial advisor on a written income plan. Everything in this video, the federal thresholds, the combined income formula, the Roth conversion strategies, the QCDs, the senior deduction, the withdrawal sequencing, none of it works in isolation. It only works as a coordinated system, and the only way to build that system for your specific income. Sources: your Social Security, claiming age, your account types, and your state of residence, is with a written retirement income plan reviewed by a qualified professional. Look for a fee-only fiduciary financial advisor 1, who does not earn commissions on products and is legally required to act in your interest. You can find them through the NAPFA directory at napfa.org, or work with a CPA who specializes in retirement tax planning. One planning session can save you tens of thousands of dollars over a 20-year retirement. Let's say you live in Minnesota. You have $40,000 in annual Social Security benefits. You have other income of $60,000. Minnesota could tax up to $34,000 of your Social Security at rates up to 9.85%. That is a meaningful annual tax bill. So you start thinking, what if I move to Florida? No state income tax, zero Social Security tax. You calculate the savings may be $2,000 to $4,000 per year. That sounds like a clear win. But here is what that analysis almost always misses. Florida has significantly higher homeowners insurance costs. In many coastal counties, premiums run $4,000 to $6,000 per year, versus $1,200 to $2,000 in the Midwest or Northeast. Property taxes in Florida are not dramatically lower than comparable Midwest states. Once you factor in local assessments, the cost of travel to see family and friends who stayed behind adds up $3,000 to $6,000 per year for many retirees. And estate planning documents need to be updated for your new state's laws, a one-time cost of several $1,000s. Data from IRS migration patterns shows that nearly 1 million Americans aged 60 and older crossed state lines in 2023, a record. But studies of high-income retirees who moved primarily for tax savings show that about 53% of them moved again within 5 years, often back to where they came from. The tax savings were real, but the lifestyle costs distance from family, unfamiliar healthcare systems, the expense of establishing roots in a new community were also real, and they frequently offset the tax benefit. The financial planning rule of thumb for state relocation: to make pure financial sense, setting aside lifestyle factors, you generally need to save at least $15,000 or more per year in net taxes after accounting for all the additional costs of the move. Below that threshold, the math often does not justify the disruption. That said, if you were already considering a move for lifestyle reasons, better weather, proximity to grandchildren, downsizing, then choosing a no-income tax state, in that process absolutely makes sense. The key is, do not let the Social Security tax tail wag the retirement lifestyle dog. The comments sections of retirement, finance videos, and forums are filled with variations of the same story. Retirees who are surprised, sometimes genuinely shocked, when they realize their Social Security is being taxed. Here is a composite of the experiences we hear most often. The first surprise: I had no idea my pension income counted against me. I thought Social Security was separate. The first year I filed in retirement, I owed thousands more than I expected, because my pension pushed my Social Security into the taxable zone. This story comes up constantly. Many retirees, especially those with pensions from government or union jobs, do not realize that their pension income raises their combined income, sometimes pushing them from zero Social Security tax to the 85% taxable bracket. The second surprise: I sold some appreciated stocks in my brokerage account. One year made about $40,000. I didn't think about what that would do to my combined income. It pushed me way over the threshold, and I ended up paying taxes on Social Security I had never paid before. Capital gains from investment sales count as income for combined income purposes. Even a one-time investment sale can temporarily trigger Social Security taxes for that year. The third surprise: I thought my municipal bond interest was completely tax-free. I didn't know it still counted for Social Security tax purposes. This is one of the most common misconceptions in retirement tax planning. Municipal bond interest is not subject to federal income tax, but it is included in your combined income formula. The Social Security tax system treats it as income for threshold purposes, even though you pay no direct income tax on it. The pattern is consistent. The Social Security tax is not complicated in isolation, but it interacts with every other income source you have, and most retirees never received any guidance on how those interactions work. They find out at tax time, when it is too late to change anything for that year. The fourth surprise: my RMD kicked in at 73, and I wasn't prepared for it at all. I had been gliding along just fine. Then in the first year of required distributions, I suddenly owed taxes on my Social Security that I had never paid before, and the RMD itself was taxed on top of that. My effective tax rate went up significantly overnight. This is the tax torpedo we described earlier, and it is almost entirely avoidable, with planning that starts in your late 60s, before RMDs begin. What all of these stories have in common, they could have been largely avoided with proactive planning. Not complex planning, not expensive planning. Planning that requires understanding the combined income formula and building a strategy around it, which is exactly what this video has been equipping you to do. Here is the big picture perspective that ties everything together. Social Security taxation does not exist in a vacuum. It is one part of your total retirement income tax picture, and the goal is not to optimize any single piece. It is to optimize the whole system. A retiree with $750,000 in a traditional IRA might have higher lifetime taxes than a retiree with $750,000 split between a traditional IRA and a Roth IRA, even though they have the same total, because the Roth portion creates a flexibility that keeps combined income lower in any given year, which keeps Social Security taxes lower, which also keeps Medicare surcharges IRMA lower. The benefits compound. The retirees who pay the least tax on Social Security are rarely the ones who earned the least. They are the ones who planned the most. Account diversification, Roth conversions, QCDs, strategic Social Security. Timing these tools together can result in a retirement where little to none of your Social Security is taxable. That is a completely legal outcome available to millions of Americans. It just requires knowing what to do and starting early enough to do it. Let's summarize everything into an action checklist. Go through each one of these and ask yourself, have you thought about this? Number 1, calculate your current combined income. Know where you stand relative to the $25,000 and $32,000 thresholds, or $34,000 and $44,000 for the upper tier. Are you above or below? Number 2, identify your state of residence. Does your state tax Social Security? If so, what are the income thresholds for exemption? Are you below them? Number 3, if you are 65 or older, claim the $6,000 per person senior deduction available from 2025 through 2028. Do not miss a single year of this window. Number 4, if you are still in the years before claiming Social Security, evaluate Roth conversions. Every dollar converted reduces your future RMDs and keeps your combined income lower in retirement. Number 5, if you are 70 and a half or older and give to charity, make your donations directly from your IRA as qualified charitable distributions. Never write a personal check to charity first and then take the IRA withdrawal separately. Number 6, plan your RMD strategy before age 73. Consider reducing your traditional IRA balance through conversions or strategic withdrawals in your 60s to reduce the required distribution amounts that begin at 73. Number 7, build a written retirement income plan with a fee-only fiduciary financial advisor or CPA, one that coordinates all of your income sources, specifically for Social Security tax optimization. Number 8, review your plan annually. Tax laws change as the recent One Big Beautiful Bill Act demonstrated. Your income changes. Your account balances change. Your plan needs to stay current. Social Security taxes are legal. They are real. And for millions of retirees right now, they are quietly eating into the income they spent 40 years building toward. But they are not inevitable. With the right strategies, the right account structure, and the right planning, you can legally minimize or eliminate the tax on benefits you already earned. If this video helped you understand your retirement tax picture better, please hit the like button right now. It takes 1 second and it genuinely helps other retirees find content like this. Subscribe to Rise and Prosper for weekly videos on exactly this kind of real money retirement information. And drop a comment below with one question. What is your biggest retirement tax concern right now? We read every single one, and your question might become next week's video.